All right, today is February 27th. We were supposed to meet on campus. Campus had an emergency, so everything's closed. Classes are technically canceled, including Zoom classes. However, we have a test on Thursday, so this is an optional class today. I'm going to record it and send it out to you guys. And let me go over the agenda that I want to do, and you guys can let me know if there's other things you want to put on the agenda. Okay, can you see my screen here, guys? It should look like a Word document. Yes or no? Can you see it? Yes or no? Can you see my agenda? I don't hear from anybody. Can you see it? Oh, I bet you're
Yeah,
putting it in the chat. Oh, you smart people. Okay. Yes, yes, yes. All right. You admit all. You guys are pretty darn good. It is 10:36 and you all just kind of pivoted. It's so amazing. Such talent the world has never seen. Okay, so this is what I want to do. I want to, of course, priority is on the test review. I got all your Excels graded, and I caved and did not give people zeros who did not get 100% perfect on their Excel files, and I sent you your files back so you could hopefully learn. But I want to go over that and talk about part 2 of the assignment. It's pretty short assignment. I want to review project 3. I would have given you a handout today on project 3. It is a very short paper, 20 points, and it is the vertical analysis, which is a way of looking at companies and doing common size statements. And you already have your companies, so that'll be easy. Or not easy. That'll be easy. You won't have to dig on the SEC site. Tomorrow, assuming our campus is open, there will be the 2 guest speakers at 1:30 in U301. Should be pretty lively. I really strongly encourage you to go. It does count for extra credit, and I've already gotten questions on extra credit from students saying, can I earn more than 6 points? Yes, I'm going to let you guys earn 8 to 10 points this quarter. Okay, and your project 3, P3 contracts are due Friday. Okay. So I have another announcement for you. So I'm going to stop sharing this screen. New share. Let's see if I can find it. No, I can't. So let me pull it up and then I'll share it. All right. And just as a reminder, we are being recorded, and welcome everybody who just came in the room. So we had, as you may remember or may not, I've experimented with some new projects this quarter. We did not do the business model analysis project that we did in Accounting 201. We are doing instead the 3 sustainability accounting projects. We're also doing poster sessions. And then finally, we're doing a very small financial analysis project. Okay, so let me do this. Let's go to. So what I did was, you were the first class that did the sustainability projects. So I didn't know how complicated those would be, or how long they would take, or how long they would take for me to grade. So you did the vocabulary quiz, you did the residential house utility bill, and then you did the energy use targets for all of Bellevue College. We are not going to do part 4, the thermostat guards in the dorms or the residential halls. You did calculating your retirement last Friday. Most of you, if not all of you, did a really good job. And then this Friday, you'll have a short essay from each team member, and we'll go over that some more. And then this is your financial statement projects. Okay. All right. And then a reflection. So with each, the first unit and the second unit, I had planned poster sessions. And so the first poster session you all did after chapter 8 and 9 exam, and I had planned a second poster session for after this.
No, I'm okay. I'm doing a Zoom class right now.
Thank you, Pearson. Um, the second poster session that would have been due Monday, I am canceling. So just because there's too many projects stacking up. So let's look at the calendar here. Can you guys see the calendar? Let's do that. Yes or no? Can you see the calendar?
Yes.
Thank you. All right. So here we are. Your account ID quiz is due here. All of those practice quizzes are due here. Here's your exam. Here's the retirement project essay. Here's the plan for part 3. Okay. This poster session I'm canceling. It's just, I want to have time to really reflect on the Excel project, and I want you to have quality time to work on the financial statement project. So I'm just going to pull it out of the schedule, and you don't have to do it. And if you really want to do it, go ahead, but it's not required. So there won't be any grade for it. All right. Then we'll finish chapter 11, the second half. Okay. And then we'll begin chapter 12, which is another one of my favorite chapters, along with the bond chapter. And that will be all on cash flow. Okay. Yes is there. Yay. Okay. So we'll have some time here. And then this is finals week. So we're literally 1, 2, 3 weeks away from the end of the quarter. Okay. This is finals week, and finals start on Wednesday and they go Thursday and Friday. Our final is Thursday at 11:30 a.m., not 10:30. And then during finals week, I have scheduled an optional review session for the 19th. So I'll be reminding you about that. It's just whoever wants to come, we can do an hour of practice stuff. Okay. Any questions about the schedule? So we're getting rid of poster session 2. We will not have poster session 2. Okay. All right. Okay. So announcements. Okay. All right. So practice exam review questions. Do you guys have specific questions for that you want to go over for the exam? Is there anything that's tricky that you want to look at? If you want to say it out loud or put it in the chat, that would be fine.
I don't have a specific question from the practice exam, but I had a few questions, or just like for the tests in general. I'm like, will there be questions on like definitions or like things like that, kind of like the quiz from Sunday?
Yes, there will be. And this is, thank you for asking that, Layla. So let me just write down what you guys are asking. Will there be theory questions from the material? Is that short? Yes, there's going to be a it's going to be about chapter 11 theory, because there's so much around forming a corporation, and so you need to know all of that. That's the 8 characteristics of a corporation. You also need to know, and I think I put it here. Let's look at the practice exam. Understand the theory of corporations, advantages and disadvantages. Understand what is par value. You know, it's an arbitrary value. Issuing common stock, preferred stock, and so forth. And then understand. So there's 2 areas where I'm pulling very short answer questions. Okay. So you want to make sure that you understand the theory. So for example, why would you pick stock financing over bond financing, that kind of thing? And, you know, and that is in that is in chapter 11, and I think it's also in chapter 10. Okay. So can you guys remember why we do that? Why do we pick stock over bond financing? So let's pull that up, since I think that's just such an interesting question. I have an exercise that I don't want to go into. Let's see if I can pull it up. If you have stock financing over bond financing, let's do this. Let's see if I have it right here. Hang on, it was. I think it's over there. Yeah. All right. Oh, we don't want to do that today. All right, let's go to the very end here. I have an example of a company needing $5 million, and they have two ways to finance it. Okay. And let's see. There we go. Here we go. All right. So 3 advantages of stock versus bond financing. Okay. It's all about control. So you want to make sure that you have control. Every time you issue 1 share of stock, that's 1 vote. But if you issue bonds, they don't get to vote. So what is a vote? So anytime a company makes any major decision, the stockholders have to vote at the annual meeting. And sometimes they're small things like who to elect for the board. Sometimes they're big things like, should we issue more stock? Should we authorize more stock? Okay. So it's a big deal. So if you go with bond financing, you do not lose, the company does not lose control to more voters. Okay. The second reason is if you do bond financing, you get to deduct interest expense in the calculation of net income and in calculating your taxable income. So you get this big deduction every year. If you have stock financing, all you get is you pay dividends, but they're not deductible. Okay. And finally, earnings per share can be improved. So it can be, for example, you can have net earnings per share, net income divided by average number of common stock shares. So if you have more shares of common stock because the company issued more stock, then you could have a lower earnings per share. And Pearson, you're asking, does the choice that the company makes depend on the company's financials, like a future ability? Absolutely. If you're a startup company, you probably are not going to have a lot of luck getting bond financing. And feel free to interrupt me, Pearson, or anybody if you have a question. Okay, so I want to go to chapter 11 and show you kind of a side-by-side discussion of this. Okay, let's see, new share. Okay, you guys should see this. It says, let's compare stock versus bond financing. Haley, there are the big advantage. So Haley's asking, is there an advantage of common stock over bond financing? Okay, there's a huge advantage. yes, you get a deduction for interest expense if you use bonds. But by the same token, you have to pay interest every year. If you have common stock, you don't have to pay dividends every year. You can skip years from paying dividends. Okay, so let's look at this company. You are Will's company. You are forecasting next year's statement, income statement. Okay, you're going to need to raise $5 million. You can either issue $5 million worth of bonds. So remember, face value of a bond is $1,000. So that's 5,000 bonds. Or you can sell $5 million worth of stock. All right. Now let's just make things simple and say the average selling price for that stock is $25. And that means you're going to issue 200,000 shares of stock. Currently, they have 100,000 shares of common stock. So after they issue the additional shares, they'll have 300,000 shares of common stock. Okay. So we're going to make it simple and say the bonds are paying 12% annual interest. You don't need to know the life of the bond as you're only forecasting 1 year out. So assume a 30% tax rate. All right. So what I want to show you is an income statement for the company. This is what we call a pro forma income statement. It's a forecast. It's in the future. We're saying if our operating income were a certain amount, what would our net income look like if we did bond financing? What would our net income look like if we did stock financing? So it's just looking at two options. All right. So here I'm just, everything in blue is the same, right? It's the same for the companies until we say, what if we did bond? What if we did stock? Okay. So here we have sales, cost of goods sold, gross margin, operating expenses, and income before interest and taxes. So this is all the same up to this point. And now we're saying, hey, interest expense, there would be none if you did stock financing. But if you did bond financing and you issued $5 million worth of bonds at 12% a year, that would be $600,000 in interest expense. Okay. Here is income before income taxes with stock financing. Here is income before income taxes with bond financing. So right there, really big difference is you're going to have a higher net income with stock financing. Okay, so that's the advantage, Haley. It may or may not always be true, but in this case it is. So you can use language like, it probably means you'll have a higher net income with stock financing. So here's income before income taxes, and here's our 30% tax rate. Well, it's going to be 30% of 1,500,000 if you do stock financing. But if you do bond financing, because the income before tax is lower, it's only going to be 270,000. So taxes are higher with stock financing. Taxes are lower with bond financing. Okay. And then here's our net income. With bond financing, net income is lower. Okay. Because you've got that big interest payment. All right. So here's net income. Here's net income with bond financing. If you calculate return on equity, however, return on equity is higher with bond financing because you have less equity in the company. It's all debt. Okay. And then where's my EPS? I want my EPS. Oh, EPS, here we go. So here we go. EPS with stock financing would be that 1,050,000 divided by 300,000. EPS with bond financing would be 630,000. And remember, it's only 100,000 shares because we didn't issue the stock. So EPS is going to be higher here probably. So interest expense is deductible, which is wonderful, but you still have to pay it. So it just depends on what your cash position is. Okay. So just understand that. And this little illustration is at the end of chapter 11. Okay. All right, so going back to the practice exam. Is there anything else? So that's the theory, bonds versus stock. Advantages, disadvantages of corporations. Understand the definition of a mortgage, a callable bond, a convertible bond, just some basic vocabulary that, and you can pull all of that off of my PowerPoints. So, all right. Okay, how are you guys? I didn't have a chance to dig deep into your posts for the practice exam. Do you guys have any other questions that you want to go over on the practice exam? I know you have. Oh, I guess maybe I want to say we've spent a lot of time on bonds and mortgages, and I want to ask and coming up with a selling price of a bond and all of that. And then my question is, how are you guys with the other stuff? Payroll, current liabilities, calculating interest expense, calculating sales tax, calculating the sales, sales and sales tax again, and more on payroll. So, and I think the other current liability was warranties. So if you, not warranty, it was unearned revenue. Okay. So be sure you guys understand all of those current liability problems that are in chapter 10. Let's see, let's go back to that. Let us make sure. Share. Okay. So if you remember, we didn't spend a lot of class time on this, but you guys did pretty well on the homework. So yeah, benefits, expense, the whole thing. So current liability, notes payable, accruing interest, paying interest. Sorry, accruing interest at the end of the month or the end of the quarter, and then redeeming the note at maturity when it's due. Okay. So we did that. Sales taxes, trying to figure out if you are told that, and I saw a couple of your posts on that were spot on, where you're told what you collected, you're told the tax rate, and then you got to figure out what were sales. Okay. So you take that 10,600 and divide it by 106% or 1.06. Okay. And then here we go with taxes, salary and wages payable. And by the way, the number one reason small businesses get in trouble with the IRS is because they don't, you know how you get your paycheck and it's lower, a lot lower because of taxes. The number one reason a small business gets in trouble with the IRS is they don't pay their employees per the law. They have to withhold Social Security and Medicare, federal income tax, state income tax if they have them. And then they have to turn over and pay it to the government. And sometimes they forget to do that second step, or they just don't have enough cash to do the second step. Okay. So the company recognizes the full expense. The salaries and wages payable is what we call our take-home pay, And then the other three are whatever was withheld from the employees. FICA tax, income tax, state income tax. State of Washington does not have a state income tax. But anything that's pulled out of your paycheck, it could be healthcare premium payable, anything like that. It could be union dues payable. Okay. And then here's them paying the payroll, putting the money, and you know, for me, how many of you who get a paycheck do direct deposit? Yay, Henry. Yay, Layla. Yay, Haley. Yeah, saves so much time. You can start paying your bills like the day of or the day before. So it's so much faster. I don't like going to the bank if I can help it. I know it's easier now. You just take a picture of it, but I don't want any delays. All right. So we call this lower amount take-home pay for the employees. All right. And FICA tax is Social Security and Medicare. And so here's payroll tax expense. And then these are not the amount that was withheld from the employees. This is the amount that the company has to pay. So these are different taxes. These are the Social Security and Medicare, the employees pay half and the employer pays half. And then these are additional taxes, unemployment feds, unemployment state. Okay, so if unemployment is if you get laid off, you can get money from the state for like 15 months or something like that until you can find another job. It's not the same as what you were earning, but it helps. Okay. All right, so here's more payroll. And then there we go. Okay. Unearned revenue, we did not talk about this. Hopefully you watched the video, but here's the Mariners selling 100 tickets for its home game schedule. Boy, they play a lot more games than the Seahawks. I just think the Seahawks are so lazy. No, I'm just kidding. So here's the Mariners recording the collection of the money for the season tickets, for the 100 season tickets, but they haven't played the games yet, so it goes to unearned revenue. And then you have to figure out, well, now they've played the game, so we got to move the money out of unearned revenue and recognize service revenue. So you got to prorate those 13 games. And the way you do it is you say, take the whole amount, divide it by the whole amount of games. So you get a per game revenue times 13 is 28,000. Okay. And there we go. And then current maturities for long-term debt, current assets, and so forth. Okay. All right. So we didn't have a lot of time to talk about that. So how are you guys with bonds? Do you guys have anything else you want to talk about in chapter 11 or in appendix G?
Did we go over like problem? I think it's page 11
I sure
on like number of shares and
this guy, yeah, I'll go there next, Zoe. But do you guys have any questions on the appendix G? I can come back to that. Let's go and look at this. Let's see. Let's take a look. Here we go. All right. All right. So can you see PowerPoint here? And then we'll go do the example. No, I don't think you can because I haven't shared it. Here we go. All right. All right. So just a quick review. There's something called authorized shares. There's something called issued shares. There's something called outstanding shares. And there's something called treasury stock. And those all have different, those are all different vocabulary terms. They all have different meanings. Okay. So authorized, it means the amount of, the maximum amount of shares a company can issue. Maximum amount. And if a company runs out of shares, they literally have to go back to their corporate charter and amend it and get all of the stockholders to vote. And I mentioned in class, a company like Walmart, who has split so many times since it really started splitting in like 1960. That company, I don't know this, but I believe this, they had to go back and get authorized more shares. Because when you're starting a company, you have no idea how many shares you're going to sell, and you have no idea how many stock splits you're going to have. Okay, so in this example, we assume 1 million shares were authorized, 400,000 shares were issued. That means they were sold. Debit cash, credit common stock, and if there's additional paid-in capital. Okay. They have 15,000 shares in treasury. So what does that mean? That means the company has gone out to the open market, the stock market, and bought back 15,000 shares. Okay. So the question is, what is the value? How many, not value, how many shares are outstanding? So the definition of outstanding is issued shares minus treasury shares. So in this case, 400,000 shares minus 15,000 shares, or 385,000 shares. Now here's where it gets a little tricky. The issued shares, these treasury shares are still considered issued because they haven't been retired, and that's an advanced accounting concept. They're just being held by the company. Most likely, they're going to turn around and pay them out as bonuses. So they're definitely shares that are moving. However, we don't pay, the company is not obligated to pay dividends for treasury stock, just the outstanding shares. Okay. These other shares here, the 600,000 shares here, are unissued. Okay. So unissued shares. All right. They have no value. They're just the maximum number of additional shares a company can sell. Okay. So let's look at this problem here. We kind of closed with that last time. And it's a lot of words. It is, I think this one is in your course pack. Does anybody know? I left my course pack at home. So let's just see. Maybe I'll see if I can find it. That'd be helpful. Then you guys could take notes. Assuming you're anywhere near your homes. Let's see. Talk to me. All right, there we go. Let's bring up the course pack.
I
And
think it's on page 88.
which page, Zoe?
Page 88.
Page 88. So let's do that. That's no good. All right. That. Yes, it is. Okay, guys, turn to page 88 in your course pack. And then you're going to be filling in these blank areas here, okay? Page 88 and 89 in your course pack. And I am going to go back to my PowerPoint, which has the same thing on it. All right. All right, can you guys see my PowerPoint?
Yes.
Okay, so Jennifer has issued 300,000 shares of stock, common stock. Jennifer Company is authorized 600,000 shares. And paid in capital on the stock is this. The corporation has reacquired, lots of vocabulary words that you got to be recognizing what they mean. The company has reacquired 15,000 shares. That means treasury stock. They've reacquired them, okay? And it has a cumulative loss, other comprehensive loss. The corporation also has preferred stock, 4,000 shares issued. But let's focus on the common stock. Okay. All right. So now I'm going to go over here. I think this one is a little too messy. All right. All right. So go back to your course pack and then let's make sure we have this. Here we go. No, we don't want that. this. All right, sorry, guys. All right. So we're gonna say, we know the 300,000 shares. So as we come down here. Okay, you guys have 90 seconds. Let's skip preferred for now. Let's look at common stock. What are you gonna put right here? What are you gonna put in that square right there? And direct message me in the chat if you think you know the answer. So you have about 90 seconds. Uh, 300,000 shares are issued. How many are outstanding? What is the definition of outstanding? I have three. Oh, I've got several right answers. So the definition of outstanding is issued shares minus treasury shares. Okay. So the answer here, I don't think it'll let me, but let's just try it. Is it going to let me? Kind of want to do that. It's going to be 285. Oh, it did let me. Yay. Okay. All right. Anybody have a question on that? It could have been before they issued the treasury stock, the language would have been, sorry, we have 300,000 shares issued and outstanding. Okay. But here we say we have 300,000 shares issued and we have to acknowledge that we had 15,000 shares purchased into the treasury. So we only have 285 outstanding. Okay. And let's see. How many preferred? So we've answered that. What is the par value? Doesn't list it here, but it does list it here. But how do you calculate par value? How do we get this number if we didn't have it already? Put the formula in the chat. How do you calculate par value? If all you know is dollar value and shares issued or shares outstanding, how would you calculate par value? Chaz, you are correct. Anybody else? Henry, you are correct. Anybody else? Alex, you are correct. Anybody else? How would you calculate par value if all you knew was dollar value and shares issued or shares outstanding? All right. So par value, I think, oh, where's my mouse? Let's see, what did Alex put down? I'm gonna use your answer, Alex. So the par value is going to be equal to par value is equal to dollars. And it depends on which one you're looking at. Are you looking at common or are you looking at preferred? Right now we're going to do common. Is equal to the dollars in the common stock account divided by the number of shares issued, not outstanding, but issued. Okay. All right. So how many common shares are outstanding? How many preferred shares are outstanding? What is the par value? Okay. So now let's go back and fill this in. What is the percent associated with preferred stock? And what is its par value? So you got to go back and look at your prompt on page 88. And they're saying the company also has 4,000 shares issued and outstanding of 8% $100 par value preferred stock. It's telling you the answer right there. Okay. So this is going to be, but what if you, so you have to get that 8%, but what if you didn't know what par value was? You would do the same thing. The balance, so the par value in preferred is going to be equal to, let's see, preferred stock is going to be equal to the dollars in the preferred stock account divided by the shares issued. Now, I just want to be really clear. So that would be $400,000 divided by 4,000, which is going to be 100. Can I get in here? Okay. All right. Now, so let's go on. What was the average selling price of the common stock? Okay. It has to be average because we don't know when the stock was issued, but all we know is the big picture. We know the total value and we know the number of shares. What was the average selling price? So anyone can answer, but please direct message me. Henry, let's see, I'm gonna calculate this. Henry, can you put your formula in for me? Please. So this, remember, this is a section of the balance sheet. It's not even this is part of the balance sheet. It's not even part of the statement of stockholders' equity, but you can see there's a lot of extra information here now than what you've been working with before. All right. Perfect. Okay. So how do we know what this stock sold for? So first off, when you make a journal entry and you issue stock, so let's say, let's issue, oh, my caps are going nuts. Let's issue 100 shares of common stock, par value $5 a share for $8. Give me the journal entry. I should say, please. Okay. Before I answer this question, Henry's already answered it, but before I answer this question, put your journal entry in the chat for me. And remember, it's okay to abbreviate CS for common stock and so forth. So how much cash did the company get and what's the credit accounts? So take about 60 seconds to answer that. So far, so good, Zoe. Rhythm, you are correct. Zephania, your cash is correct. Henry Griffin, you are correct. Henry Holtrop, you are correct. How much cash did the company get? And then what's the credit? Jason, you're half correct. The cash is correct. But remember, we can only credit common stock for par value. And that answer goes to Jason and Zephania and Zoe. All right, here we go. Chaz, you are correct. Okay, people, give me the answer. How much goes to cash? And then what are the stockholders' equity accounts? Reagan, your last account has a different name, but the dollars are correct. Gosh, I'm freezing. Are you guys cold? Ugh. That explains it. Here, Reagan did it. Zoe. Reagan, yes. Yes, yes, yes. Okay, yes. Okay. So the journal entry is debit cash, $800. How did we get that? 100 shares at $8 a share. I'm just going to do this as three things. Credit common stock at par value, 100 shares at $5. And credit that funny new account, additional paid in capital. Don't leave off the CS. If you leave off the CS, you'll be marked wrong. For $300. Okay, so what that means is we brought $800 of cash in, and now we're telling the reader we put 500 in common stock, but 300 was additional paid in capital over the par value. Okay, so let's look over here. We have a common stock account of 900,000. And we have APIC of 380,000. Okay. All right. So if that were one big journal entry, that means replacing what we have here with our small numbers, the debit to cash would have been debit 1,280,000. Credit common stock 900,000 and credit APIC common stock 380. Okay. If that had all happened at one time, and it doesn't necessarily mean, does everybody understand that journal entry? Debit cash, credit common stock at par value, credit APIC for the additional paid in capital. You can see them right here. Okay, here's common stock, APIC common stock, and then the regular common stock account. Okay, so the question is, what was the average selling price of the common stock? Well, we know we sold them for $1,280,000. And then the question is, how many shares were issued? And again, we're going to use issued shares. And I forgot what the answer is. Henry, you did it. So let's see. 1,280 divided by 3. Thank you. 300. $4.27. Okay, so let's think that through. Okay, par value is $3. We know we got more than par, so we got about a third more than par. So you should just, when you do these kind of calculations, just be sure to kind of double check them in your head, make sure they make sense, okay? All right. And if the annual dividend on preferred stock is 32,000, what is the dividend percent for preferred stock? Okay. So give me the math for that one. So you paid 32,000 in dividends. Preferred dividends. What is the percent? So it's almost gonna feel like interest. It's not interest. It is truly a dividend, but okay. So if you didn't know what this was, but you were told they paid a full dividend of 32,000, preferred stock is really funny. They have this percent that says if you have money for dividends, this is what you have to pay first before the common shareholders get theirs. So you would look at this 32,000 and you'd say, well, the par value of the preferred stock is 400,000 and that equals 0.08 or 8%. Okay. So you don't need to be told you don't need to be told the percent. If they tell you that they paid a full dividend, you could calculate it. Okay. All right, guys, let's take a 5-minute break, 7-minute break. And I want to, let's bring up my, hang on, I want to bring up my new share. Okay, so I want to go over Excel and the project as well. And then that won't take the full hour, but it'll, I want to make sure we do that. So let's stop and let's take a 5, 7, 8-minute break. Okay. And return at 11:35. Okay. All right. And if you have any questions, put them in the chat, please.